Hey everyone, this is Kirk here again at Option Alpha, and in this video we're going to be going through some backtesting data on VXX call spreads. Now the reason we're doing this is because I'm going through the process right now of trying to figure out how can I trade an automated strategy for VXX. I want to trade a short volatility strategy on VXX. I've seen a lot of traders do it. I've seen other traders do it. I've read about traders doing it and like the success that people have with this, and so I would like to do the same thing. I'd like to have a portion of my portfolio in some sort of short volatility VXX play, but I want to do it smart. I want to do it intelligently. I don't want to blow up my account or, blow up the position. I want to, figure out a way to do it. So I'm literally going to just document this whole process. Today's going to be a part of that process and like one step in the journey towards building a bot, and that's doing some backtesting research. Now, this may not be the end all be all for you. Maybe it's the beginning, maybe it's part of your journey, but for me, doing some backtesting data just kind of helps me sift through the types of strategies that I might want to deploy for VXX. And so I want to go through that process here today, and you can kind of see what I do and what I'm seeing, and I've got some backtests already queued up for you. So this is the first one that we're looking at, and let me just kind of describe these three backtests here, and we could kind of take them bit by bit if you want to, but I did put them all up on one screen so that you can see all three of the backtests, and you can see they go until June 22nd, 2023. That's the last data because we kind of updated on a monthly basis, on a rolling basis. So it's got very fresh, very new data, recent moves in VXX. All the splits are accounted for, the reverse split. So that's all good. And what I want to do here, or what I want to show you, is that there's three different things that I did to kind of test. And these are the three that kind of really separated things out for me. I did some more testing on some other variations, and so I guess I couldn't show like every possible variation that you can possibly test inside of a video in a couple minutes. But in this case, the first one here is actually the first one is number B. Let's go through A actually. So the A version of the test, which is the green line here, that was a 20-day to expiration call spread in VXX. Now, most of these, or all of these tests, are set up the exact same way, which is just give it a starting allocation, just a minimum starting allocation. And it doesn't really matter for that because I did all position sizing at one contract. So this kind of really normalizes the test across different portfolio levels. You can test different levels like 1% of your portfolio and do scaled versions of that. But I just did one position at a time, so everything is sequential. There's no stepping on toes. It's just like one single position in VXX at a time. And that's the way I do a lot of testing. Then you can do multiple variations of it. But this really helps for me, like really sift through like, okay, what are the major categories that I can start focusing and honing in on as I start to think about building out a potential strategy. So it's like, I've got all these choices of all these things I can do. Well, start testing and start seeing like what are the levers that kind of push and pull things. So in this case, it was testing out of a short call spread. So VXX, by its default nature and the way it's designed, it's basically going to be dragged down lower in price. That's why it goes through reverse splits all the time, just because of the setup of the contracts. I think we did a podcast on this before, but the way that the contracts kind of roll and how they use the underlying futures and volatility. And so it's just dragged lower by default. Now, it has these crazy spikes in its price, though, and that's what you really have to be concerned about. Is like it can, when volatility explodes, I mean, VXX can go really, really high. So in this case, we're doing a defined risk for sure with the short call spreads. We would never do this with a short call or undefined risk position. And then what we did in this first test is we tested 20 days to expiration, and we did the short delta at 50. So that's essentially selling the short call right at the money or closest to the money. And then we did the long delta at about 30. Now you can play around with these as you go, and this may be part of the honing in or optimization phase that you would go through. But this is a pretty good start for where we kind of ended up. We tested some variations, and we kind of ended up in this 50 to 30 range as probably a good place to start. And then we started messing with some other variables. Now, again, in this case, we were looking at 20 days to expiration, which was the main thing. And the only other thing that we did is we just took the position off basically right at expiration or the day before expiration. Notice here we didn't do any profit taking, no stop losses, nothing. It was just literally let the position run, okay? So that is test number A. Now in test number B, what we did is we did the exact same thing, except the only thing that we changed was this. We changed the duration of the trade from 20 days. We said, okay, if 20 days works, can we go out to 30 days? And so that was test number B. And when we did the test number B, and again, changed nothing else, profit taking was all the same, etc., we found some different results. Then we said, okay, well, that works a little bit different. Can we go shorter? So maybe we can get shorter duration. So we come in closer. That gives us more trades, more frequency. The numbers work out better for us, maybe. And so we ran test number C. And test number C was, again, everything exactly the same, except the only thing that we changed here was the duration, which was 10 days. So to me, this now gives me that really good opportunity. And this is what I look for when I do backtesting, is like, I would like to see the separation. There has to be some point at which things don't work and they do work. And like, what is that break point? And then you can start to hone in on those like levers or levers, if whatever you want to call them, like as you start to build out your strategy. And so clearly it's pretty evident here that the short VIX call spread, at least the way that we have it set up with these deltas, when you're trading in a short duration, it broke and it didn't do really well. And you can see even after it went through a pretty tough period at the beginning, I mean, right at the beginning, it had a pretty tough period. It really didn't recover from that point. It kind of went sideways and it just kept falling and tripping all over itself. And so it really didn't end up working out well. If you look at the data and the stats for strategy number C or variation C here, which was 10 days, you can see that the profit factor was sub 1, which to me is like a strike, or one of the strikes that I like go against a strategy, which profit factor is just really total profits over total losses. So it's answering the question, if you put $1 in, could you get potentially $1 or more out? In this case, you put $1 in, you got 97 cents. I don't particularly favor strategies like that where you're putting money in, your expected outcome is not good. Had a decent win rate. I mean, the win rate wasn't terrible. It definitely traded a lot more contracts than the other versions traded. So you can see that the version B, which was 30 days, and version A, which was 20 days, definitely trade a lot more contracts, which makes total sense because you're trading 10 days. So you're able to recycle capital at a faster pace. And I think it was, around the same, like worse loss. The max wins just weren't there. You just weren't taking in enough premium. So you could see like it really didn't work out for this thing. So you're holding it for a short period of time. You probably ended up mostly churning your account by trading the short duration contract. So that was a bummer on C, but at least we know. And that's really the key. Like when I go through this, I think, okay, if I'm building out a strategy, what do I want to see? And in this case, I want to see that separation. Like, where do things start to really break? And you can test more versions of this as you go. Okay, so from here, then you really have to decide on version A or version B and how you kind of want to go through this and how you kind of want to, move around these numbers. Now, I personally look at version A and version B as being very similar. And you can see just visually here, like version A and version B are almost identical, right? I mean, they're very little difference. If you start to dig into the numbers, there's obviously some differences between them. You go out a little bit further, which is version B right here. This is the 30-day contracts. You traded less contracts overall. You had a little bit higher win rate. You had a little bit better profit factor, little bit better Sharpe ratio, right? So your Sortino ratio was a little bit better too. It's just some of these ratios for these were a little bit better. At the end of the day, it doesn't dramatically make a difference in the outcome. It didn't look like it, like trading 20 to 30 days. So you could probably enter trades between that spectrum in a 5-day, 10-day range or something like that. You probably wouldn't have a big discrepancy. But if you got down to the 10 days, you probably wouldn't do too well going down to that 10-day period. It didn't seem like you actually, gained anything by that. In fact, you lost by doing it, okay? So if I were to take this now, and I'm just walking through my process because I'm literally doing this. I want to get a strategy and a bot built out eventually for VXX. And so part of that process is backtesting and data and research, okay? If I go through this now, and I like to start all my testing with no filters, nothing. I'm just testing expirations, testing deltas, maybe testing some of the profit-taking stuff here and there. But after that, then what I want to start doing is I want to start playing with some of the variables. Now, One of the variables we tested, and I didn't do a video on this, but we tested it, was start taking some of the profits, and do we take profits early? And generally we found that for most of the different variables that it didn't work out as well. So for VXX, it was really, you kind of hold the thing most of the time and you kind of suck as much premium out of it as possible. That's where you get the biggest bang for your buck. Not that those strategies didn't work, it's just they didn't work as effective as, in this case for some of these, as holding the position the whole time. But what I did is I actually took that first, or the 30-day one, which was to me a little bit better. So that's version number B in this case right here, but it's switched over to by itself right here. And I took this one as the base model. So for me, this was the base model. This was the one that I wanted to go after as saying like, okay, how can I potentially improve the performance of this strategy moving forward? Now for VXX, what I thought was, all right, well, there's times where VXX is really, really low, right? So times where VXX and volatility are super, super low. And where I get hurt on this strategy is when volatility expands and balloons and goes really, really high, right? And so my thought process was, can I use RSI to basically identify those time periods where VXX gets super, super low and potentially try to avoid some of those trades. So don't get into a trade if, RSI on VXX is insanely low, like really, really low, market's uber complacent, maybe avoid those trades. Now remember, in the base case scenario, we had nothing. There was nothing. It was just religiously entering a position. So now it's a little bit about, how do you potentially optimize some of this trading? So here's what I decided to do. I decided to actually break it up into two components. Okay, let me actually say this before I show you the data. On the other side, what I looked at was I said, okay, well, if I'm going to avoid positions when RSI is really, really low, then alternatively, if RSI is really high for VXX, that might suggest that VXX is on a huge tear, right? Like the price of the security is significantly higher, and it's on a big move because volatility is exploding. So if volatility is exploding, can I focus my testing on just those environments to see if it's a better opportunity to either A, just wait for those environments, right, and forget everything else? So do I just wait for those few times a year where volatility explodes and forget the rest of the trading? So that's one component. Or do I aggressively maybe up my position sizing during those moments? So during those moments, position sizing is high. During the rest of the time, position sizing is a little bit low. So here's what I did. The first thing I did is I reran and copied this test. And you can do this by just going up here and saying create a new backtest from these settings. You click this, you put in all your new information and create a version of this test. So I reran the test, exact same criteria, except the only thing I did here was I modified it to basically avoid really high RSI, because I'm going to test for that separately, and avoid really low RSI readings on VXX. Now you can, again, go even further on this. If this base case works, you would, possibly continue testing 20 or 30, 20 and 60 or 20 and 55 or something like that. But in this case, I just said, okay, if RSI is below, RSI has to be above 25 in order for me to enter a position, and RSI has to be below 50. So I wanted to get that component of the portfolio that I might want to trade to be that component that's kind of the middle range volatility and range of VXX. So not too low where the market's complacent, and not too high, because I want to test that separately and see if that works by itself, or maybe during those environments I scale into it and get a position size a little bit higher. And what you found is that you actually found that, weeding out those environments and obviously weeding out the, really extreme volatility environments, you still did really well. So this kind of base core portfolio here still did well. The profit factor was still pretty decent. You still had a lot of trades. So you didn't really get a lot of trades, a significant reduction in trades. There wasn't that many opportunities. If you go back to the base case here, it was 165 trades. And when you weeded things out, you got 139 trades. Still a pretty good win rate on these trades, pretty good profit factor on these. You had some pretty good, positions generally, and you didn't see much of a drawdown. Your max drawdown, which looks like visually you went through a couple times, it was about 6%. So you really didn't have too bad of an issue. And again, this is on a $10,000 account, but only trading one contract at a time. So still very impressive for a small contract size that's, I think, initially less than 2% for most trades. So the next thing I did is I said, okay, now I'm going to create another version of the backtest. So I spun up another version. This one is only looking at RSI over 50. Okay, so now I said, all right, forget every other environment except for the environments where RSI is specifically over 50. Now, it's not going to be that it equals just the difference between the first two tests, because these tests are run independently, so they could be, overlapping each other, and sometimes there could have been more trades because of the sequential nature of entering a trade and then volatility expanding and coming back down. So these numbers are not going to add up where like one minus the other one equals the other one. So there was 81 instances where this purely entered a position anytime that RSI was above 50. And when that happened, what you did see, not only was it was just profitable by itself, just doing that, but you did see that the profit factor for these types of setups were much better. Not only that, the win rate was a little bit higher for these. The Sharpe ratios were a little bit higher. I mean, from all intents and purposes, it was just a better outcome trade, which makes 100% logical sense, because if volatility is expanding and VXX is on an upswing, and then you only sell call options or call spreads when VXX has a huge move up and RSI is really high, which doesn't happen that often. In this case, it happened and we only captured, 81 times from 2011 until now, right? So it's not that many times. But when you did capture it, it looked like it ended up being a better trading opportunity altogether. Now, if you compare, and I know I'm going back and forth, but I'm just going through the process here. If you compare this to the original strategy of just relentlessly trading the whole time, you did have a better win rate just relentlessly trading with no tilting or aggressively trading those higher opportunities. You did have a better total P&L if you just consistently traded it the whole time through the good and the bad versus trading it only when RSI was above 50. So there's value, what I learned in this is that there's value in maintaining this position, and the consistency that this strategy brings is there's a significant amount of value in doing that. But at the same time, what I think could be really cool is the ability to scale into these opportunities where you can now take what we know for sure, that if RSI is above 50 for these VIX call spreads, or VXX call spreads, that it looks like a better trading opportunity. There's a better profit factor for those. So on a risk-adjusted basis, it looks like better trades. So can you now combine this into a bot that when RSI is below 50, we now start to go ahead and enter a regular position size, maybe one contract. And when RSI is above 50, we enter into two contracts, if that makes sense. The last thing that we can do is we can test, and I think this is something that I would test here too, and we can just start the test and see what it ends up coming back with. But here, I basically stripped out the ability to enter positions with really, really low RSI readings. And so I wonder now, and this is just how I would think about this if I was doing this myself, which I'm doing this myself right now, but I wonder, because you had this strategy, which made so much sense just trading it religiously without any adjustments, does stripping out low RSI readings, do I actually lose by doing that? Is that detrimental to the portfolio because you didn't make as much and the profit factor went down in those cases when you started to contain those RSI readings? So one thing that I'm going to test is I'm going to create a new test here, and I'm going to keep the RSI below 50 because I know, and I've already tested specifically RSI above 50 over here. I know that those work out, but I want to remove this filter on the bottom level. So now it's, okay, this might be the other component of the portfolio is RSI just purely below 50. This might be the smaller component of the backtest. Okay, so that finished up here, and you can see that you did improve your performance if you just stripped out those trades below RSI, those trades that were lower than 25. You can see that the profit factor went up. You can see that the return on capital went up. The total capital that you earned on that went up. You had more trades, which was good, so the trade count was good. So it's a really interesting one. You can go back in the video just a little bit and see the comparison there. But In this case, it looked like it worked a little bit better actually, which sometimes seems counterintuitive, but makes sense if you think about like just the downward nature of that VXX strategy, that actually just, really stripping out and removing the top level, positions ended up working out, decently well for your strategy. So if you combine these two, not like you can combine them and it would work out perfectly, but these two tests here, which is basically all VXX trades sub, that, and then all the other trades that are above, I think that if you scale into the more aggressive trades when RSI is higher, and you kind of scale down to the regular normal position size when VXX is lower, I think you end up seeing potentially the combination ends up being a little bit better. So we can't test that directly in here yet, but that's a good hypothesis that I will keep working on and keep using as the basis for thinking about strategies. So I hope this helped out, just kind of going through this. I know it was a lot of data, a lot of charts back and forth, but I mean, realistically, like I go through and do lots of testing like this around these different variables all the time. And that's some of the ways that I go in and, start figuring out, okay, what's going to work out, what's not going to work out. And you can now make some combinations inside of your portfolio and start figuring out what types of strategies might work for you. So again, for me, I desperately want to have a bot that's trading VXX, doing a short volatility strategy in VXX. It's going to be a small bot, small position size, but you don't need a big position size to, looks like do well if you can control that position size. But what I'm trying to do now is just go through the process of really doing the research and doing the digging to see what does that strategy look like for me, and how might I use backtesting to now start to inform other phases that I get into, like potentially paper trading different strategies in the live market, or doing some more backtesting and more analysis. So I hope this was really helpful for you. If it was, please let us know. I'd love to know. And until next time, happy trading.